Well, I have 7 o'clock, so I think we'll get started. Good morning, everyone, and I'd like to welcome everyone to the Field Crops Virtual Breakfast this morning. This is the final edition of the 2021 season. It's been a really good a good year for the virtual breakfast, well attended, and we appreciate that. So we're going to get started off this morning. Just a little housekeeping before we start. If you're a participant, please mute yourself during the presentation so we don't have any distractions. Please sign in with your first and last name. To do that, you click on participant list at the bottom of the screen, find your name and hover over it, click more, then rename yourself so we have the accurate information. Please ask your questions in the chat box, which is found at the bottom of the screen. We'll answer them at the end of the presentations. We'll have plenty of time to cover that. And at 7:30, Phil will come and give us the RUP and CCA codes for this presentation. We want to thank you on behalf of the Field Crops team for participating this year. It'd really be helpful for us if you go in the chat and fill out our evaluation survey as we start to plan for next year. We want to take into consideration all your input as we build and design the breakfast for next year. And again, Phil's going to share that in the chat. And again, just to remind everyone that all MSU Extension programs are open to all. We really appreciate the demographic data that you put in. The collection of that data for programming participants is an important mandate of all aspects of Michigan State University Extension programming. Of course, this is voluntary, and the information that you're going to provide will be not used in any way to identify you personally, but as the members of the group being a participation in this program. And that link will be in the chat box as well. So we thank you for filling that out. So with that, I'm going to introduce Dr. Corey Clark. She's going to talk about farm tax management. So Corey, I'm going to stop sharing and you can share your screen and begin. Good morning.
All right. Good morning, everyone. All right. Do we have my screen?
Yes.
Awesome. So as Paul said, I am Corey Clark. I am the farm business management educator in the Thumb area. There's 6 of us around the state. I cover the Thumb. And we do all sorts of things, financial analysis and business planning wise. And this time of year, tax planning is starting to be a big thing. And I get into it because I've seen the impact that tax planning can have, both from like long-term tax planning standpoint. I see some very profitable businesses who pay fairly low taxes compared to how profitable they really are. And I've also seen farms burned pretty hard by not planning in advance. Okay, so we open with, why is tax management so important? On one hand, it's like, duh, well, to optimize our taxable income. No one wants to pay more taxes than they truly owe. But more specifically, it's a serious problem to have adjusted gross income be above what we expect. Creates problems, right? The obvious one is high tax liability. And I've worked on tax planning for a while. In one farm, pretty early in that process, called me in on December 27th and said, hey, I've had a pretty good year. Turned out they also sold a lot of their prior year crop in the same year, bumper crop, starting to sell their crop. And they had, pretty high net farm income. And we were trying to get it down so that it was, a manageable tax liability. And we maxed out depreciation. They prepaid as much as they could with the cash they had available, and we ran out of options. It was really late and we ran out of options. I pulled in the big dogs and we did as much tax planning as we could, and their tax bill was about $30,000 more than they had expected. And they weren't a huge farm. They were 1,000 acres, and that hurt. So again, the obvious one is an unexpectedly high tax liability, but also taking in the year-to-year variation and just hoping taxes kind of average out. It's expensive. Taxes don't average out the way that the farm income actually does. things like we have progressive tax brackets. So the more income, the higher the tax percentage, and on any given year, plus tax credits have income eligibility limits. Things like the farmland preservation credit and the health insurance subsidies if you get your health insurance through the marketplace. And also if you have losses some years, self-employment doesn't average out because you don't get an extra benefit if you have a loss any particular year. And the thing is that we can use bad years to make planning opportunities for the good year, the good years. And then of course, it's super important in the good years. So of course, I am here to convince you to try to tax plan in advance. I know you guys are really busy and it's a weird time to talk about tax planning. But of course, this is the last virtual breakfast. So that's one reason we're talking about it in September. And the other reason is because it makes for more flexibility to plan in December. So why start planning now? Well, this year, it's a particularly good idea because there is a potentially valuable crop out there. And the market's not giving us a lot of incentive to store that crop. Plus, last year wasn't a bad year either. And there was a lot of government payments. And if you pushed crop forward or did any other tax management strategies, you may have a high revenues from the beginning of the year to add to whatever you sell before the end of the year. And then, as I said, why think about this in September? It seems pretty silly, right? This is something we do in December. But the decisions you are making now about marketing, about paying down operating loans, and other expenses and bills, those impact the flexibility that you have planning in December. So like the December 27th farmer lost their flexibility and we didn't have a lot of options. And then that tax planning impacts the taxes due on March 1st, of course. So the most common tax planning tools are depreciation, or more specifically, accelerated depreciation, and prepaid expenses. And these are fantastic tax planning tools. We'll talk about them in the tax planning tools section. But leaning too heavily on accelerated depreciation, it reduces your flexibility in tax planning if you lean too heavily on it, because depreciation is one of the decisions we can make after the end of the year. And if you've maxed out the depreciation that you are depending on, you lose that flexibility and your tax planning essentially ends December 31st. However, it is a fantastic tool for refining a tax plan. And then the other issue with accelerated depreciation is that if you take all of the expense in the first year and you have a loan on that piece of equipment, let's say, you have to make those payments in future years without a deduction. So it can create a future tax problem and a future cash flow problem, which may not seem like an issue if you're planning, if you want to plan this year. And I mean, we don't know what next year's going to be like, right? But the problem with prepaid expenses is that in the end, those two are limited by available cash. They're great because they're a one-to-one reduction in net farm income. But if you don't have the cash available to do the prepaid expenses, that becomes a pretty limited option. Okay, so how do we do tax planning? What are you signing up for if you say, okay, I'll do this tax planning thing? The first step to do a complete set of tax planning, there's a lot of ways to just look at things and move forward, but some really good tax management starts with creating kind of your baseline tax liability. So everything you know up to this point, everything that's required of you between now and the end of the year, and what does that do to your taxes? And then the next step is to incorporate your management plan, which is, what you spend a lot of your time thinking about. Incorporate the marketing you want to do, the prepaid expenses you want to do, and what does that do to taxes? And then assessing a target net farm income, setting that net farm income. And all of these are steps you really want to take that with your tax professional. And then every last one of them, and then developing a tax management strategy. So like using those prepaid expenses and depreciation, also timing your sales and that sort of thing. Also want to involve a tax professional. So if there's a theme through all this, kind of looking at the overall steps, it's that it's important to have your information, your plans, and your tax professional. So the first step is to collect your year-to-date farm information. A lot of this is easier if you have a budget and a solid records keeping system and ideally some planning from last year. But it's not impossible if you're starting from basically today. You want your year-to-date transactions, of course, your self-employment income, farm, of course, any other business or contract work, your non-self-employment income like wages, retirement, any rental income, and then other things that impact taxes, adjustments like health insurance, tuition, IRA contributions, and those sorts of things. And it does not have to be a perfect line for line profit and loss. We want to know those general sets of information and get some good totals of year-to-date information. And then, so some of that, of course, is non-farm income. And some of the additional information you'll need is from last year. So another reason to involve your tax professional. They're going to have a lot of the information from last year's tax return that you'll need. Any deferred income, depreciation from your prior year's purchases, essentially your minimum depreciation for this year. And then the last part of information is what you expect or what you need to do in terms of commitment, what you've committed for sales. And what you're committed to as far as bills. So your contracts that you have with the payment times that are associated with them, and the bills that you're already committed to. And then calculating from that the corresponding tax liability. This doesn't have to be perfect. If you leave depreciation, I'm so sorry, as a refining tool, then this is important as an estimate, but it doesn't have to be your full-on year-end bookkeeping. So step 2, this is the part where you're optimizing your business first. What happens if you make the decisions that really optimize your business's profit? This is the stuff you guys spend a lot of time thinking about. So what does it mean for your taxes? And so the first part, of course, is the crop that you're harvesting. What is your marketing plan for that? And you've developed that based on prices and the timing that prices and storage and those sorts of things that determine what timing you want to sell your crops. And then prepaid expenses, some of them do a lot to save costs. And so what are those cost-saving advanced purchases that you would like to make? But then there is the cash flow implications of this. Usually there's some other bills that farmers want to pay off. In particular, debt payments are an important consideration because while expenses create a tax deduction, principal payments do not. And so even though they aren't actually going on your tax return, they're still an important consideration because they will help determine what cash is left for those prepaid expenses. So cash flow has to be considered as part of incorporating your management decisions into your tax planning. And then you calculate the result, right? And is this an acceptable result? What does it do to, how does it compare to expectations? How does it compare to a typical tax liability? What does it do to your carryover crop? If this is acceptable, fantastic. If not, you need to develop a target and develop strategies to get to that target. So what are those targets? And I would not be a good economist if I didn't say it depends. And there's a couple of things that it depends on. The first one is the tax issues. The tax brackets, the expected marginal tax rate, the tax brackets that you're going to fall into. The income tax brackets, as we know, progressive brackets, and it depends on your taxable income. And of particular note, there's a big jump from the 12% to the 22% tax bracket. And that may be a decision that you can impact. And it may be a decision where you always fall into that 22% tax bracket for the last portion of your income. But that is a big jump, and it's one to consider as far as your tax rates. In addition, your taxable income determines your capital gains tax rates. And if you've made significant asset sales, like land or other things that would have capital gains issues, you can impact those capital gains rates. They might be 0, they might be 15%, or if you're on the high end, they might be 20%. And then second, what are the tax credit eligibility implications? So there's a number of tax credits that have that are impacted by your adjusted gross income. As I said before, the farmland preservation tax credit, sometimes taxable income is consistently above what makes that a possibility. And sometimes the consideration is just that as you increase taxable income, the availability of that credit goes down. Another really big one is the advanced premium tax credit, which is the subsidies, the health insurance premium subsidies that reduce your health insurance premiums if you get your health insurance from the marketplace. And those subsidies are actually a tax credit that you reconcile on your tax return. So if the adjusted gross income that the marketplace calculated those from at the beginning of the year is different than at the end of the year, than what it turns out to be at the end of the year, you may need to repay some of those, some of that advanced premium tax credit. It's less of a big issue in 2021, but it's then say 2019, but it can still be a significant amount of money. Back when if your income was high enough, you didn't qualify for any advanced premium tax credit. Now there is a portion that more people qualify for. But at that point, I've seen required repayments in the tens of thousands of dollars. So considering the tax credit eligibility is really important. The other big one is the child tax credit, but the income limits on that are pretty high now. On the flip side, there is the management issues. So like what is reasonable for your farm? What is your optimal taxable income for your farm? And it'll be determined by things like non-farm income, how big your farm is, what happens when you minimize your net farm income over time, where does that turn out to be? And like I mentioned before, your typical tax bracket. So you'll be able to identify what are your breakpoints. And then what do you have control over? You have some control, but maybe not as much control over your sales timing if you don't have storage on your farm. And some bills are just plain due. So different factors weigh into that for different farms. So then there's really nothing surprising on the tax management strategy list as far as the main tax strategies, no rabbits to pull out of a hat. Although, so prepaid expenses, delayed crop sales, and accelerated depreciation. There are some advanced tax management tools. They tend to be farm specific, and some of the really useful ones, if you have extremely high income in a particular year, might require multiple professionals, financial professionals, your tax professional. And that's another reason to be taking at least an initial look at tax planning this time of year if you expect to have a higher taxable income than usual. This is a particularly good year to look at prepaid expenses to enable your optimal marketing plan. But additional reductions beyond that net kind of net zero planning requires thinking about cash flow, things like how you're financing, when you're making loan payments, how you're using credit cards. If you are recording credit cards in your records this way right now, the credit card is an expense. Credit card purchases are an expense when you make the purchase, and then you later pay off the credit card. And then of note, deferred payments on sales that you make before the end of the year. If you're expecting to get the check after the end of the year, that needs to be written into your contract. You can't legitimately just pick the check up late. And then again, refining tax management before year end and also after year end in terms of your planning with depreciation. So I would contend that managing taxes, which is really about optimizing your taxable income, is maybe, and over time is more than worth the time that it takes, because the automatic averaging of net income over time isn't the same. Even using income tax averaging only takes care of just the income tax. It doesn't take care of all of the other issues that are involved in tax planning. But there are lots of tools. And not only the list of 3 that we talked about in the last slide, but more tools that your professionals may find that are useful to your farm. And then I would finish with, use those professionals. They put a lot of time and effort into developing a strong expertise in how to do taxes, and then that expertise is useful in how to plan taxes. So use that to make your business more successful. And I will hand the baton back to Paul.
Thank you, Corey. Thank you very much. I'd remind everyone to put any questions for Corey in the chat box. Before we get into the question and answer, I do want to thank everyone, field crops, our specialists and presenters that made this program a success, specifically Phil Cates. Phil's done a tremendous job organizing this group, making this thing happen every week. It just doesn't happen by the snap of the fingers, and Phil's the one that's taken the bull by the horns, and we're sometimes us field educators, it's kind of like herding cats, but it's done a nice job of keeping us in line. So with that, I would like to, there's a couple questions and comments in the chat box. First, I'd like to introduce Mike Staten for a message about the soybean harvest field day. So Mike, if you could turn on your mic and share screen if you need to, I think.
Paul, can you hear me?
Yes, I can.
Good. I really appreciate the opportunity. Actually, Monica and Paul are helping with this field day this year, and appreciate your help. It's our 10th annual field day. It's an annual event, and we try to help soybean producers reduce their harvest losses. And so it's an important concept. It's a chance to see the equipment run in the field and see some different machinery run and see some different management practices implemented. So the date of the program is next Tuesday. If you're interested, it's going to be in the Breckenridge area. Please, there's information in the chat, but you just call my phone number and leave a message, and that will get you registered. So just to encourage you, we're going to start with a really good Litwiller barbecue lunch and from Litwiller Catering, and then we'll go watch the equipment run. So if you're interested, please call me before noon tomorrow. Thank you.
Well, thank you, Mike. I'd like to remind everyone, if you have questions for Jeff or Corey, to put them in the chat. I do have a kind of a question for Corey. There's a lot of challenges that farmers are having, I think, right now with high input costs and the availability of inputs, and how that might impact. Sometimes people are making purchases now because it's just the availability of the availability of the product. So does that impact when we sell? Are there tax implications to that? And because I think farmers are in a dilemma right now.
There are certainly tax implications to that, but it doesn't have to be a problem. Sorry. You can match that up with timing of sales. You can use less of depreciation to match that. So I think particularly if tax planning to some extent starts early, you can make whatever decisions make sense from a management standpoint and work the tax planning around that.
Okay, thank you. We have a couple of other specialists on this morning. Anybody have anything that they would like to talk about? I know, Marty, there's tremendous amount of discussion on the national media with the tar spot. Is there anything to think about in planning?
Hey, Paul. Yeah, well, I guess unfortunately, now we're starting to see the impacts as combines are running across fields. I mean, the damage looks pretty similar to 2018 in terms of the magnitude. So in 2018, there were reports of, 50, maybe 100 bushels lost to tar spot. But that was really confined to the west side of the state, maybe southwest. Just where disease was primarily occurring at that stage. Now disease, for the last couple of years, it's been moving across the rest of Michigan. And, we're just seeing the effects of that. So wherever we've had conducive weather and there's been plenty of disease inoculum, we're seeing, the pretty significant effects of tar spots. So in terms of management now, it's really just about making sure that you're checking those fields, I guess, in terms of stalk quality. And potentially getting stuff off a little bit wet, paying a little bit for drying, as opposed to trying to pick stuff up, once it's lodged. That's really the most important thing, I think, at this point.
Okay, thank you, Marty.
Well, I have a question for Marty on tar spot. Many of the producers in the eastern side of the state have had tar spot come in probably later than other parts of the state.
Mm-hmm.
So I'm looking at maybe the first week of September is when they really started to see a lot of it show up. How fast will it affect that plant? Does it kill it quickly, or how exactly does the tar spot affect the plants as far as killing the plant and then potentially affecting yield?
Yeah, I mean, so in terms of yield loss and even stalk quality, the earlier disease moves in, the greater the damage is going to be, right? The greater the yield loss and the greater that stalk quality is going to be affected. If disease is coming in really late September, it really shouldn't have as much of an impact. One of the big problems with tar spot, it certainly does shut the plant down early as well. And so, I mean, this is obviously if we're shutting the plant down early, we're going to lose a lot of yield potential. And it's a very significant factor as well in terms of silage production, because we can go from, wet to dry very, very quickly with tar spot. And it does affect quality parameters too in silage. So it depends on, depends on when disease was coming in. I think it was fairly hard for people to find tar spot up in Huron County, partly because they're in drought really, right? And so there probably isn't a great deal of damage up in Huron County, but Shiawassee County, past the Saginaw, there's definitely some fields that are hit pretty hard.
Okay, thank you, Marty. Are there any other questions for any of the specialists? Chris?
This is Chris here. So we had that fall armyworm mini outbreak in the last few weeks, and it's the grass strain. So it'll be looking at alfalfa, teff, grassy pasture kind of situation, maybe some cover crop, oat cover crop. So those things have pupated. Moths are probably flying, and I can't get myself real worked up about the next group of larvae, because these are tropical and like below 60 degrees. They don't function very well. I think if there's egg masses out there, we'd actually have larvae hatching now. And the best thing that happened is that Jeff caused this weather mass to come over and a lot of rain and these cool temperatures. In theory, if there's egg hatch, this is the best thing. It wipe these things out. So, if you are seeing some oddball things happen, give me a call, but it's hard for me to get really excited about this insect right now because this isn't its optimal conditions, let's say. So that's about it.
Thanks, Chris. Manny?
I know the people on golf courses are all excited, but I really don't care about that. So, whatever.
Thanks, Chris. Manny, I see you're on. Is there anything you'd like to share with the group this morning?
Not much, Paul. I have a
Okay.
screaming child here with me, so excuse me if you see any screams here. I think Jeff mentioned this dry down study we are doing. He showed you guys some data. That's something we're pretty interested in. So I think, yeah, we'll share some more reports from what we observe in terms of the dry down from here onwards. It's been pretty crazy. I mean, we are seeing a daily decline of more than even 2% points in some of those plots. So we'll see what this new weather that Jeff is bringing will do to that.
Okay, thank you. Any other questions or comments? If not, I'd like to again thank everyone for joining us this season. We look forward to having you participate next year. And quite obviously, this is a family-friendly program as well with the young children sharing the screens of some of our specialists and educators. So with that, thank you, everyone. And just referring to the comments in the chat, go green.
Go white.
Oh, white.